Something is happening behind the scenes of the XRP market. It's a structural shift that most retail investors are completely missing while they're glued to the daily price charts. While everyone was distracted by price swings and market noise, a deliberate, calculated move was made to tighten the supply of XRP. This isn't just a random market event. It's an engineered supply shock designed for a very specific purpose. We're talking about a 500 million XRP lockup, a move that permanently took a massive chunk of supply off the table for years. And it happened at the exact moment institutions finally got the green light to begin buying XRP. Not by the million, but by the billion. This is the story of how engineered scarcity is colliding with an unprecedented wave of institutional demand. It's the blueprint for a modern-day gold rush, and it's unfolding right now. But there's one mechanism most people still don't understand, and it's the part that controls sellable supply. Ripple just lit a match. They've locked away 500 million XRP, taking a huge chunk of supply off the table at the exact moment that massive institutions are lining up to buy it by the billions. This isn't a random event. It's a calculated move to create scarcity. In this video, we'll break down how this engineered supply shock is setting the stage for a modern-day gold rush for every single XRP holder. Because the next part explains why this move had to happen before institutions could buy at scale, and most people missed it. Let's be honest, for long-term XRP holders, the last year has been a masterclass in frustration. The end of 2025 was a brutal psychological test. While the fundamental news had never been better, the price seemed stuck in a painful consolidation. This matters more than people realize. After hitting a staggering multi-year high of over $3.60 in July 2025, the price entered a prolonged correction. For months, XRP hovered in a range between roughly $1.77 and $2.15. Every piece of good news, every partnership, every positive development felt like it was being absorbed into a black hole with no impact on price. It's a feeling many of you know well, the belief that your asset is fundamentally undervalued, yet held down by forces beyond your control. This period was defined by a split personality in the market. On one hand, you had bearish technicals and sideways price action that fueled fear, uncertainty, and doubt, the classic FUD. On the other, the institutional world was quietly preparing for a hostile takeover of the available supply. But that part of the story wasn't making headlines. Keep this in mind. This becomes critical in a minute. The pain point for the XRP community has always been this feeling of suppression. The theories are endless. Market manipulation, whale games, coordinated selling. But the reality is often simpler, yet far more powerful. The market was undergoing a fundamental repricing. Large players were accumulating supply, and the derivatives markets were resetting. This detail changes how you should think about supply forever. Data from late 2025 showed that spot volume was muted and traders were reducing their leveraged exposure. This wasn't a sign of collapse, but of a market cleansing itself, shaking out the weak hands and preparing for a move based not on hype, but on real structural market dynamics. The frustration was real, the pain was palpable, but it was all setting the stage for the agitator, the event that would pour gasoline on the fire of an already constricting supply. This is where the story gets interesting. The supply of XRP isn't just shrinking by accident. It's being systematically and deliberately tightened from multiple angles. This isn't a theory. It's a multifaceted reality confirmed by on-chain data. First, let's talk about the main event. This is supply pressure number one, the 500 million XRP escrow. Blockchain records confirm that a Ripple-linked account executed an escrow create transaction, locking away 500 million XRP until November 1st, 2028. This transaction was secured with a multi-signature setup, meaning it wasn't a casual move. It was a deliberate, enforceable, and irreversible decision to remove those tokens from any possible circulation for years. Why does this matter? For institutions, predictability is everything. They can't allocate billions of dollars to an asset if they fear the issuer could dump a massive amount on the market at any moment. This lockup and the entire escrow system established back in 2017 provides cryptographic proof that the supply schedule is disciplined and transparent. It's a signal of long-term intent, a foundational element of trust for asset managers building financial products like ETFs. This single lockup is just one piece of a much larger puzzle. As of early 2026, there are still over 34 billion XRP held in Ripple's programmatic escrows. Combine this with the relentless, though small, deflationary pressure from the burn mechanism. Every single transaction on the XRP ledger destroys a tiny fraction of XRP as a fee. As of early 2026, this mechanism has already permanently removed over 14 million XRP from existence. It's not a huge number on its own, but it's a constant deflationary tick, forever reducing the total supply. Now, layer on top of that the most aggressive component of the supply shock. This is supply pressure number 2, and it's far more aggressive: the drain from exchanges. On-chain data shows a dramatic plunge in XRP held on centralized exchanges. In October 2025, exchanges held around 3.76 billion XRP. By the end of the year, that number had collapsed to a 7-year low of approximately 1.6 billion tokens. Think about what that means. In just a few months, more than half of the readily sellable supply of XRP vanished from the open market. This wasn't a one-off panic withdrawal. It was a sustained, directional outflow of tokens into private wallets and institutional custody. When this much supply leaves exchanges, it means one thing: people aren't planning to sell. They are holding for the long term. This creates an incredibly thin market. The less XRP there is available to buy, the more volatile and explosive any spike in demand becomes. This is the textbook definition of a supply squeeze. It's a spring being coiled, tighter and tighter, waiting for a catalyst to release the tension. In a thin market like this, price moves stop being gradual, then they become gaps. And this is the moment where supply stops being a background variable and becomes the dominant force in price. For years, the promise of institutional adoption was just a narrative. In late 2025, it became a reality, and it arrived with the force of a tidal wave. And the uncomfortable part? If this thesis is right, most retail won't benefit the way they think. Not because they're wrong, but because they'll wait for confirmation that never comes. If you want to stay ahead of this cycle, this is the part that matters. The single most important development was the approval and launch of multiple spot XRP ETFs in the United States. This was the moment the market had been waiting for. It provided a regulated, accessible, and insured way for hedge funds, asset managers, and even pension funds to gain exposure to XRP without the complexities of direct custody. And the demand was immediate and ferocious. In just their first month of trading, US spot XRP ETFs attracted over $1.07 billion in net inflows. By early January 2026, the cumulative net inflows had surged past $1.18 billion, with total assets under management climbing to $1.37 billion. And this is where the math starts breaking people's assumptions. Let's translate that into physical XRP. Analysts estimate that these ETF products have already absorbed a massive amount of XRP directly from the market. These aren't paper derivatives. Spot ETFs have to buy and hold the underlying asset. They act as a giant vault, pulling XRP out of the circulating supply and locking it away. This institutional buying is happening at the exact same time that the available supply on exchanges is hitting historic lows. Do you see the collision course we're on? This ETF effect was only made possible by increasing regulatory clarity in the United States. Landmark legislation like the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or GENIUS Act, was signed into law in July 2025. This, along with progress on the Digital Asset Market Clarity Act, began to establish clear rules for the industry, reducing the legal risks that had kept institutional capital on the sidelines for years. The resolution of Ripple's long-standing legal battles and the relisting of XRP on all major U.S. exchanges were the final green lights. But the institutional story goes far beyond ETFs. It goes to the very heart of XRP's original purpose: solving the multi-trillion-dollar problem of cross-border payments. The International Monetary Fund, the IMF, has explicitly recognized digital assets like XRP as a potential solution to the slow, expensive, and inefficient correspondent banking system. The current system leaves an estimated $27 trillion locked up and unproductive in Nostro and Vostro accounts worldwide. The IMF has published models on the future of global payments, emphasizing the need for neutral, efficient bridge assets to connect different currencies and ledgers. This isn't some crypto dreamer's fantasy. This is one of the world's foremost financial institutions laying out the theoretical groundwork for a system where an asset like XRP is the essential plumbing. As banks and financial institutions begin to adopt this model, analysts project they could lock up tens of billions of XRP for their own operational liquidity needs. This isn't speculative buying, it's utility-based demand. They aren't buying it hoping the price goes up. They are buying it because they need it to move money. So you have three layers of institutional demand hitting all at once. Speculative and allocational demand via ETFs, operational demand from banks for payments, and a clear regulatory framework making it all possible. This is the stampede. This brings us to the payoff. This is the solution to the frustration, the release of the coiled spring. This is the gold rush. When you combine an engineered supply shock with an institutional demand stampede, you don't get a gradual price increase. You get an ignition. The market structure has been fundamentally altered. The plunging supply on exchanges means there are far fewer sellers available to meet new waves of buying. Think of it like a highway. A year ago, it was an 8-lane superhighway with plenty of room for traffic. Today, it's been squeezed down to a single lane. What happens when a convoy of institutional trucks tries to merge onto that 1-lane road? A massive traffic jam, and the price to get through skyrockets. And here's the uncomfortable truth. In this kind of market, hesitation is the most expensive position. We saw the market preparing for this throughout late 2025. The derivatives market underwent a significant reset. Open interest, the total number of outstanding futures contracts, saw sharp fluctuations, indicating that excessive leverage was being flushed from the system. This is incredibly healthy. It means the coming price move is more likely to be driven by real spot buying, by ETFs and institutions absorbing physical XRP, rather than by speculative, leveraged bets that can be easily liquidated. A market with less leverage is a market primed for a more sustainable and powerful trend. This is why the frustrating price action between $1.77 and $2.15 in late 2025 was so misleading. It was the quiet before the storm. It was the final phase of a Wyckoff reaccumulation pattern where large players absorbed the remaining supply from discouraged retail sellers before the next major leg up. As of early 2026, the price has already begun to show signs of life, breaking out of its multi-month downtrend and reclaiming the critical $2 psychological level. This isn't just another rally. This is different. This is the result of a calculated, multi-year strategy. Ripple's disciplined escrow schedule, the constant deflationary burn, the regulatory victories, and now the institutional grade products are all converging. The gold rush analogy is fitting. In a gold rush, the value isn't just in the gold itself, but in the scarcity and the difficulty of acquiring it. The easy gold has been mined. The XRP that was sitting on exchanges, easy to buy, is gone. The new prospectors, the BlackRocks, the Fidelities, the institutional giants, are now arriving with industrial-grade equipment ready to mine whatever is left. And they are competing for a dwindling supply with long-term holders who have no intention of selling. But what do you think? Are we at the tipping point? Is this the final accumulation phase before the supply shock becomes undeniable? What's your price target for the end of 2026? Drop it in the comments below. I read every single one, and I want to know what this community is thinking. This is the moment where patience is rewarded. Every XRP locked in escrow, every token burned by a transaction, and every coin vacuumed up by an ETF tightens the supply noose. This is how a gold rush begins. It doesn't announce itself with a trumpet. It starts with a quiet shift in supply and demand, a shift that has now become a deafening roar for anyone who knows where to look. The narrative for XRP has fundamentally changed. We've moved from a story of legal battles and potential utility to one of verified supply scarcity and realized institutional demand. The 500 million XRP escrow was not just a single transaction. It was a statement of intent. It was another brick in the wall of a financial fortress being built around the XRP supply. The pieces are all on the board. The shrinking exchange reserves are a fact. The billion-dollar wave of ETF inflows is a fact. The ongoing escrow schedule and burn mechanism are facts. We are witnessing a live case study in the economics of scarcity. For years, the XRP community held on through uncertainty, believing in the technology and the vision. Now that belief is being met with the most powerful force in any market, a massive imbalance between supply and demand. The institutions are here and they are buying. The supply is disappearing and it isn't coming back. The game has already started. And when supply disappears this quietly, the chart won't warn you first. Your absence of opportunity will.